Hi, I'm Bradford Ferguson. I'm here with Matt Smith to share our Tesla report that we just made public yesterday. This video is going to be a read through of the report. So we're literally going to read the report. Occasionally we may stop. I might ask Matt a question, or we may comment on something, but mainly it's going to be a read through. So you can listen to it at 2 times speed. Matt wrote a vast majority of this report. He did 99% of the work, put a lot of love and effort into it, and brought his experience. So this report's on Tesla, and we're looking at Tesla primarily 2025, 2030. As of February 6, 2023, clients and employees of our firm, Halter Ferguson Financial, own Tesla stock and or options, and thereby stand to materially benefit from a rise in the share price. Past performance is no assurance of future results. Halter Ferguson Financial is a registered investment advisor with its principal place of business in the state of Indiana. A complete list of all recommendations will be provided if they're requested for the preceding period of not less than 1 year. It should be assumed that recommendations made in the future It should not be assumed that recommendations made in the future will be profitable or will equal the performance of securities in this list. Opinions expressed are those of Halter Ferguson Financial and are subject to change, not guaranteed, and should not be considered recommendations to buy or sell any security. All right, go ahead, Matt, take it away.
All right, we'll start the read through now. So this is the executive summary section. Tesla is leading the transition from internal combustion engine vehicles to electric vehicles. The stock underwent a phenomenal run up from late 2019 to late 2021 as the company experienced drastic growth in both revenues and margins. But as economic concerns mounted in 2022 and the Fed initiated a series of significant rate hikes, growth stocks like Tesla were hit hard. Despite beating estimates for revenue growth and earnings in 2022, the focus shifted to the perception of weakening demand and potential margin pressure in 2023 and beyond. We believe that these issues are legitimate, but are more than outweighed by emerging catalysts, which have the potential to drastically change Tesla's addressable market and financial profile. The core investment thesis, as well as potential risks to that thesis, are highlighted in the table on the next page.
Go ahead, Matt.
So key risks here are, number one is macroeconomic headwinds. Rising interest rates and a potential recession would hit the automotive industry particularly hard, creating demand or pricing pressures. The second key risk is multiple compression. Tesla's price to earnings ratio has been re-rated down, but is still significantly higher than other auto companies. In the short term, it is possible that Tesla could trade closer to an auto company than a growth or tech company. And the third key risk is regulatory risk. Pushback on Tesla's full self-driving and autopilot program could limit upside potential or cause legal and regulatory hurdles. Now onto the investment thesis. The first of those is the strength of the core business. Tesla has been revalued lower amid demand concerns, but manufacturing prowess and the emergence of full self-driving, or FSD, as a financial contributor will ensure that Tesla maintains world-class margins. The second core investment thesis is that the energy business is ramping. Analysts have historically ignored the energy side of Tesla's business, but Tesla Energy is about to undergo a step change in deployments and profits. And the final investment thesis is upside optionality. Tesla's Tesla's best-in-class real-world AI capabilities can create massive upside potential in both autonomy and robotics. So this is the financial juggernaut section. Tesla's financial results over the last 3 years have consistently surprised Wall Street. When Tesla released its Q4 2022 earnings report in late January, the company reported full-year automotive gross margins of 28.5%. This level of profitability was unthinkable to most industry observers just a few years ago. But perhaps even more impressive has been Tesla's ability to stay lean as they grow and realize incredible operating leverage. Operating margin in 2022 increased 464 basis points to reach 16.8%. This is a figure which most manufacturers would salivate over if they could achieve it at the gross margin level, let alone as an operating margin figure. Tesla's financial metrics are truly astounding and give an indication of just how far the company's manufacturing prowess has come. To fully appreciate Tesla's accomplishments on manufacturing efficiency, it's informative to compare these figures to Toyota, a company which has long been considered the gold standard of automotive manufacturing. Just a few years ago, analysts were expressing incredulity at the notion that Tesla could reach, let alone surpass, the heights of Toyota's renowned Toyota production system. This system of manufacturing has been a focus of case studies for decades, and many companies have implemented versions of this system and its lean concepts into their operations. Many industry watchers believed at the time that Toyota's profitability level represented a ceiling which a newcomer like Tesla could only hope to aspire towards. In comparing the two companies' results, however, it's clear that Tesla has not only met the level of profitability achieved by Toyota, but has blown clear past this level. This is even more impressive when you consider the results were achieved with roughly half the production coming from Tesla's Fremont factory, which will ultimately prove to be the company's least cost-effective facility. The exchange from Elon Musk and a Barclays analyst from Tesla's Q4 2017 earnings call, which took place in the middle of Tesla's struggle to ramp the Model 3. We might have to go back over this part. I think
the exchange is
yeah.
I think it's not a complete sentence, but that's okay.
So the exchange between Elon Musk and a Barclays analyst in the adjacent box is from Tesla's Q4 2017 earnings call, which took place in the middle of Tesla's struggle to ramp the Model 3. With the benefit of hindsight, we can see that Tesla was able to accomplish exactly what Musk said they would accomplish 5 years ago. Today, they have become the new benchmark for manufacturing profitability. Yet this is clearly not.
I'm going to go ahead and read that part. So Brian Johnson from Barclays says, yes, I'd like to follow up a little bit on the first question around some of the manufacturing roadblocks, as well as the comment about building a machine to build a machine, which I believe was the title of a 1990 MIT book about Toyota. Could you maybe give us some more discussion really on the managerial culture, the process level, how you would benchmark yourself, for example, against a Toyota factory, which seems to be able to launch a new product in about 3 to 4 months to ramp up? Or at the other extreme, that was a long question, Brian. At the other extreme, because I know Mr. Field came from there, kind of what Foxconn does and its goal to replace humans. But in particularly, you talk about the managerial processes, not so much the robots you're putting into place. Elon Musk responds, well, I'm pretty sure Toyota cannot ramp up a new product in 3 months. In fact, I'm 100% certain about that. Brian Johnson says, okay, but within that, then what are the differences, though, in the way you're going to be managing the factory? Elon Musk responds, the most fundamental difference is thinking about the factory really as a product, as a quite vertically integrated product. Brian Johnson responds, right, which is the Toyota production system. Elon Musk responds after a long pause, yeah, we don't think so. Go ahead, Matt.
Yet this is clearly not even close to the end game for Tesla. Internal projects, including the 4680 battery cell, structural battery packs, Project Highland, and efficiencies yet to be realized in Berlin and Austin, have not yet hit the financials. And as great as these improvements will be, they will ultimately pale in comparison to the software margin potential of driving and robotaxis.
Go ahead on financial juggernaut continued.
The market's incredulity at Tesla's goal to leapfrog Toyota's manufacturing efficiency seems to have parallel with today's skepticism of full self-driving. The current state of the technology is analogous to the profitability of Tesla during the Model 3 ramp. Yet investors should not be looking backward at the historical financial statements, but forwards to the likely future position of a company. After experiencing firsthand the rapid rate of improvement in this technology, we believe that the take rate of full self-driving is likely to increase substantially in the coming years. This has the potential to offer a further step change in profitability, which will make the current figures look rather quaint by comparison. Indeed, Tesla even appears to be guiding to this outcome, as evidenced by wording in the outlook section of their last several earnings reports. Bradford, maybe we should jump to that for a second to grab that quote.
While we continue,
So
the quote is, while we continue to execute on innovations to reduce the cost of manufacturing and operations, over time, we expect our hardware-related profits to be accompanied with an acceleration of software-related profits. We continue to believe that our operating margin will remain the highest among volume OEMs.
this software is not only a potential source of margin on new car sales. Tesla has approximately 3 million vehicles Tesla has approximately 3 million vehicles with hardware 3 on the road today, the vast majority of which did not come with FSD purchased. But the owner can, at any time, opt to buy or subscribe to FSD to enable the functionality on their cars. As the software continues to improve, it is likely that some percentage of these initial non-adopters will upgrade to FSD. If just 10% of the roughly 3 million opted to upgrade, that would be nearly $5 billion of incremental margin on vehicles which Tesla has already sold. Now we're moving on to the Tesla Energy section. While Tesla has historically been viewed as an automotive manufacturer, the company has a long history in the energy sector. This part of the business is generally overlooked by most analysts and investors simply because the revenues and margins have been negligible when compared to Tesla's automotive business. The history of Tesla Energy is rooted in Solar City, which Tesla acquired in 2016. Since its founding in 2006, Solar City has provided solar panel installation services to homeowners and later expanded to offer solar leases and power purchase agreements. Today, Tesla Energy is responsible for the development and production of Tesla's energy storage products, including the Powerwall, PowerPack, and Megapack. The company also provides energy management software and services to help customers optimize the performance of their solar and energy storage systems. While Tesla does not break out the split of its revenues and margins between solar and stationary storage, we estimate that the storage revenues are roughly an order of magnitude larger than those of the solar business. Furthermore, the margins are likely to be much higher on storage than on solar. So for purposes of this report, we will focus primarily on the opportunities around stationary storage.
And technically, the Power Pack is discontinued now that the Megapack keeps growing in size.
They do have it still on their website, though, I noticed.
Oh, really? Okay.
When I wrote this report, it was on there. I don't know if you could actually order it, but it was shown on there. But let's talk about the Megapack opportunity. Tesla has had a substantial backlog of Megapack orders for about as long as the product has existed. The entire company was initially cell-starved, and automotive applications were given first priority over Tesla Energy. The lumpiness of supply translated directly into the lumpiness of energy revenues, which has led many to believe that Tesla Energy did not contribute to the valuation of Tesla. Furthermore, the lack of consistent supply or a dedicated manufacturing facility meant that margins were far from optimal. But for the first time in its history, Tesla is no longer constrained by access to battery cells. Tesla's Megapack manufacturing process is ramping up with a dedicated facility in Lathrop, California, capable of manufacturing 40 gigawatt hours of Megapacks per year once it hits capacity. As shown in the chart on the previous page, the 40 gigawatt hours of stated capacity at Tesla's Lathrop factory is roughly an order of magnitude more than Tesla has ever delivered in a given year. In fact, it's roughly on par with the total worldwide deployments of stationary storage, which according to Row Motion were 46 gigawatt hours worldwide in 2022. When looking at these numbers, it might seem logical to conclude that Tesla's either built too much capacity or that it will face significant pricing pressure, given the appearance of limited demand. However, it appears likely that demand is spiking to extreme levels in the near future, and that historic deployment levels are more reflective of available supply than inherent demand. Tesla clearly believes this to be the case, as their goal is not to stop at 40 gigawatt hours. At their Battery Day event in 2020, Tesla outlined a path to reach a staggering 3 terawatt hours of total capacity between automotive and stationary storage by 2030. While we don't believe it's prudent to give Tesla full valuation credit for this audacious goal, it is clear that they intend to be leaders in the global battery market. And the recent announcement of 100 new gigawatt hours of capacity at Gigafactory Nevada is evidence that they are putting their plan into action. Demand outlook. It is also important to note that Tesla is not alone in thinking that the energy storage market is poised to undergo explosive growth. Bloomberg New Energy Finance estimates that cumulative storage deployments will grow 15x between 2021 and 2030. This total figure is lower than Tesla's stated goal, but the BNEF forecast for 2030 increased by 13% in just 1 year. We believe that industry watchers will continue to raise forecasts for future demand, and the ultimate winners will be those who can successfully ramp up capacity. A leading indicator for near-term growth in the stationary storage market is to look at battery interconnection requests. Whenever a new asset is added to the grid, such as a solar plant or a battery, the local grid operator conducts a grid interconnection study, or GIS, in order to confirm that the grid can maintain proper working order in a variety of conditions with the new asset added. Companies wishing to add new assets will submit an interconnection request to the grid operator, which will then conduct the GIS over the course of several years. The process concludes with many companies withdrawing the interconnection request and some obtaining an interconnection agreement, which will allow the asset to operate on the grid. Given the length of this process, examining the top of the funnel is a good way to see trends in future grid asset deployments. When looking at the data presented in the chart above, it is clear that there is an absolutely staggering increase in storage requests. Indeed, in 2021, storage requests roughly doubled relative to 2020 and were up about 10x from 2019 levels. And this data predates the demand surge, which is likely to be incentivized as a result of the Inflation Reduction Act.
And I should note that the request for storage connects are 400 gigawatt worth of requests. So it's a lot more than the 40 gigawatt hours that Tesla is building. Inflation Reduction Act. Go ahead, Matthew, on this part. I'll do the chart.
You'll do the chart? Okay. The
Yep.
Inflation Reduction Act of 2022 contained a grab bag of benefits intended to incentivize clean energy initiatives within the United States. This was truly a sweeping piece of legislation with incentives aimed at nearly all levels of the supply chain. It's hard to imagine a bigger winner from this legislation than Tesla, which will realize benefits on both their EV and energy businesses. This table that Bradford will walk through highlights some of the most significant provisions of the new law and describes the potential impact to Tesla. This list is not exhaustive and doesn't include the solar investment tax credit nor alternative fuel refueling property tax credit. Both will also benefit Tesla.
Okay, first one is EV tax credit. And what this is tax credits of up to $7,500 per vehicle, subject to EV pricing and buyer income limits. This credit will significantly lower the cost of ownership for most Tesla vehicles in the US, thereby boosting demand. Second is commercial EV tax credit. Tax credits of up to $40,000 for commercial vehicles like the Tesla Semi, giving Tesla increased demand and pricing power. Next is the investment tax credit for storage. Stationary storage projects will receive a credit of 30% of total capital costs, but this can reach up to 70% if requirements are met for additional incentives. Additionally, the credit previously required that batteries be charged directly from renewable sources like wind and solar. This new credit eliminates that requirement, further improving the potential economic use cases for stationary storage. The combined impact of these changes is likely to be a drastic step change in demand for storage and improved pricing power for companies such as Tesla, which have scaled domestic manufacturing. Fourth is the advanced manufacturing tax credit. This provides a credit of $35 per kilowatt hour for domestic battery cell manufacturing and $10 per kilowatt hour for domestic battery pack manufacturing. Tesla will split this benefit with Panasonic for 2170 cells produced in Giga, Nevada, and will get the full benefit for in-house 4680 cells made in Austin and Nevada. For a 75 kilowatt hour Model Y built with domestic 4680 cells, this would translate to $3,375 in tax credits per vehicle. Interstate charging is the next one. This grants fund interstate charging stations as long as the stations are open to all vehicles. Tesla has recently indicated they will be opening up their station to non-Tesla vehicles, which will enable qualification for this funding mechanism, as well as a new revenue opportunity for billing non-Teslas to charge. The last one is the corporate alternative minimum tax. So this is not a benefit, this is a potential offset. So while all the above provisions of the IRA help Tesla either directly or indirectly, there is also a new corporate alternative minimum tax, which could offset these benefits. Tesla currently does not pay US federal income tax, primarily due to their large balance of net operating loss carryforwards and other deferred tax assets. Under this new law, many tax loss methods no longer offset pre-tax earnings, and a 15% minimum tax is imposed. However, it is important to note that Section 38 credits, including advanced manufacturing tax credit, can be used to offset up to 2/3 of the corporate alternative minimum tax.
3/4, not 2/3.
3/4, thank you.
Yeah.
75%.
So now we're going to talk about hardware margin potential. Gross margins on the Tesla energy business have historically been negligible, leading many analysts to ignore the potential of this part of the business. However, there is reason to believe that this may be changing. As noted previously, Tesla has had a backlog of greater than 1 year, essentially since the Megapack product was launched in 2019. Back then, the product was priced at roughly $300 per kilowatt hour, depending on the order quantity and some other variables which impact the price. Elon Musk noted in a comment to Clean Technica in 2020 that Tesla's cost to manufacture Megapacks was approximately $300 per kilowatt hour, with cells being 2/3 of that cost and the balance of systems being the final 1/3. Given that the cost was roughly equivalent to the price, it's understandable that the product did not become a significant driver of value. Furthermore, Tesla's pricing was essentially fixed at the time of the order, leading Tesla to bear the raw material price risk well into the future when the Megapacks would actually be manufactured and delivered. In the intervening years, lithium carbonate prices in particular skyrocketed, leading to a significant increase in cost of goods sold relative to the amounts contemplated when the pricing was first established. This has led Tesla to take 3 steps to increase margin. Most significantly, Tesla has pushed through a number of price increases, which have raised the price nearly 70% to about $500 per kilowatt hour today. Second, Tesla's contract for Megapacks now includes commodity cost pass-through language, which allows for sharing of commodity price fluctuations, especially around lithium. Finally, Tesla has introduced a new product, the Megapack XL, and a dedicated 40 gigawatt hour manufacturing facility in Lathrop, California. The increased size and implementation of a dedicated facility should allow for a streamlined manufacturing process. Assuming Tesla's improved efficiencies, net of material cost increase, have resulted in pricing in the $250 per kilowatt hour range, gross margins of 50% are theoretically possible. Retail analysts have done detailed work justifying the potential for 50% gross margins, or even higher, by using Tesla's own data as well as third-party cost buildups. While the number sounds unlikely, we believe it is at least possible for Tesla to generate these margins once they work through the lower price backlog and fully ramp the Lathrop manufacturing facility.
Credit to Zero Sum Gain, 33 on Twitter.
For purposes of valuation in this report, we will focus on EBITDA and net margins. In 2022, Tesla posted a 23.6% adjusted EBITDA margin, which was only marginally lower than its 25.6% gross margin. This was clearly a much lower figure for the energy portion of the business, but we believe this will change as energy scales and the higher priced contracts are deployed. We also believe the pricing and margin dynamics are likely to change significantly over the course of this decade. Currently, demand far outweighs supply, and Tesla has a tremendous amount of pricing power. We believe this will lead to energy EBITDA margins peaking at around 40% in 2025. However, as the industry scales up, there will be both supply chain pressures around the mining of raw materials, which could lead to cost increases. Additionally, scaling up total deployments by 10 to 30% or by 10 to 30x over the course of a decade could very naturally change the payback dynamics for end customers. Got an extra word there. Just as scaling up Tesla's automotive business. Just as scaling up Tesla's automotive volumes by 50% per year requires ASP decreases to sustain the total addressable market, or TAM, the energy business will similarly need to reduce pricing to reach Tesla's terawatt-hour scale ambitions. Given these dynamics, we have assumed that pricing for storage products will decrease by 8% per year after 2023, reaching $270 per kilowatt hour by 2030. We further assume that EBITDA margins will decline as a result of this lower price, settling at 30% by 2030. In addition to the hardware margin, there is also a significant advanced manufacturing credit of up to $45 per kilowatt hour for cells and packs manufactured in the United States. Tesla is drastically ramping up its in-house cell production capacity, as evidenced by its recent announcement of 100 gigawatt hours of new 4680 cell manufacturing at Gigafactory, Nevada. As can be seen in the adjacent table, LFP cylindrical cells are the lowest cost option for battery cells, coming in at just under $80 per kilowatt hour, according to an MIT study. Tesla's cost may well be even lower than this, and with the $35 per kilowatt hour credit at the cell level, the margin potential for megapacks made with domestic 4680 cells from Gigafactory Nevada will be truly staggering. The credits from these cells alone will be worth an extra $4.5 billion annually to Tesla once Tesla reaches 100 gigawatt hours of scale, and there is little reason to believe that Tesla will stop ramping domestically once that facility is built out. Gigafactory Austin is ramping 4680 production already, and it will also qualify for these credits. These credits are pure margin and are likely to be a significant driver of earnings growth in this decade. Energy services and software. While the bulk of the revenue opportunity for Tesla in the short term is undoubtedly in the hardware sales, services and software sales will play an increasingly important role in the longer term. As Tesla's hardware sales accelerate in the next decade, the company will have a stream of recurring revenue on the cumulative deployed base of assets. We believe that this revenue stream will warrant a high multiple in the long run due to its high margin nature. The fact that this is recurring and therefore relatively low risk. Let me just say that over again. We believe that this revenue stream will warrant a high multiple in the long run due to its high margin nature, the fact that it is recurring and therefore relatively low risk, and the fact that it will be growing at a very high rate for a sustained period of time. The following sections discuss Tesla's various software and services revenue in more detail. First is maintenance contracts. Tesla's Megapacks come bundled with a maintenance contract, which equates to approximately 0.2% of the upfront capital cost on an annual basis, escalating at 2% per year. This service includes annual inspections of each Megapack to identify potential areas of concern, as well as cleaning the ventilation system and cabinet to ensure optimal performance. It also covers coolant refilling and replacement of gaskets, pumps, and fans once every 10 years. This service is analogous to long-term service agreements offered by OEMs or original equipment manufacturers like GE and Siemens on their power equipment. According to conversations with industry participants, these companies typically sell their hardware at close to break even, but make their margins on the LTSAs, which their customers are obligated to enter into if they wish to maintain the manufacturer's warranty on the equipment. Tesla not only has high margins on their hardware, but is also able to require annual maintenance payments for the life of the assets. While these payments are undoubtedly small today, when Tesla achieves scale, they will become more meaningful. For example, when Tesla has cumulatively deployed 1 terawatt hour of Megapacks, the associated maintenance fees will be over $1 billion per year. AutoBidder. AutoBidder is a real-time trading and control platform that provides asset management and portfolio optimization. AutoBidder connects data from real-time energy markets with the operational data from a utility's energy asset. Using machine learning and other techniques, AutoBidder optimizes the financial performance of a site. While many providers offer this type of service, the decision logic of batteries is much more complicated than that of a typical power generating asset like a wind farm or natural gas power plant. In those cases, the cost of production is known and does not change throughout the day. As long as the market price for electricity is greater than the cost of production, the decision to sell is made. With batteries, however, the optimal behavior is much more difficult to determine. Unlike power plants, batteries have a limited duration of discharge. Determining the optimal time to sell in a market where electricity prices can move 100% or more in a matter of minutes can be very difficult. The same type of trade-offs occur when determining the optimal time to charge the battery. Further complicating matters, for the battery to qualify for ancillary services payments, there may need to be some reserve amount of charge remaining at all or most times. These types of uncertainties are not well equipped to be managed by the traditional systems which have fairly basic economic logic. If Tesla's in-house AI prowess can result in better energy marketing platform than its competitors, then this functionality alone could be a factor in Tesla winning bids for large stationary storage projects, in addition to generating revenue on the AutoBidder service. PowerHub. PowerHub is an advanced manufacturing and control platform for managing distributed energy resources, renewable power plants, and microgrids. PowerHub is Tesla's version of a supervisory control and data acquisition, or SCADA system, which is common for controlling all large-scale energy assets. Microgrid controller. Microgrid controller provides real-time control of parallel grid-forming sources and variable renewable generation, in addition to intelligent load and solar forecasting. This will be applicable to a small subset of projects which primarily operate in remote areas disconnected from the larger grid. Opticaster. Similar to AutoBidder, Opticaster forecasts and optimizes energy resources in real time. While AutoBidder is for larger industrial projects with access to wholesale power markets, Opticaster provides similar benefits to distributed energy resources within the retail and virtual power plant market structures. Virtual machine mode. One of the grid ancillary services traditionally only available to large turbines is spinning reserves, which are available due to the mechanical inertia of a spinning generator. Megapacks in virtual machine mode can emulate the grid stability benefit and thereby qualify for payments in grids which compensate for this capability. While the dollar value of services and software will be smaller than hardware sales, this section is services margin potential. While the dollar value of services and software will be smaller than hardware sales, they nevertheless provide a key role in helping customers to realize the objectives of their investment in a battery system. The value proposition for batteries can be difficult to quantify for an end user, and use cases will vary drastically between behind-the-meter customer applications and grid-scale utility applications. Behind-the-meter applications are installed on a customer's premises, typically to support the load or generation on that site. Behind-the-meter energy storage systems are typically used to manage customers' energy usage, reduce their energy costs, and improve the reliability and resilience of their power supply. Grid-facing applications for stationary storage are used to support grid stability, manage renewable energy integration, and provide various ancillary services to the grid. The customers are typically utilities, which get the cost approved by their regulators and therefore are sensitive to criteria beyond simply the price of the system. The graphic on the next page helps to visualize the different value streams available to different customer types. In making an investment case for the purchase of a battery system, customers develop a value stacking approach to their returns. This can be an incredibly complicated endeavor and one that is better suited to an automated software decision-making than human intervention. For example, a customer who wants to have a battery on site to optimize their time of use pricing. For example, imagine a customer who wants to have a battery on site to optimize their time of use pricing. If they discharge their battery completely during a time of peak rates in order to lower their electricity bill, they run the risk of losing backup power capability. Therefore, having an integrated suite of software services which can optimize the value stacking trade-offs and decision-making is a significant driver of customer value. Tesla's world-class AI capabilities are very well suited to this data-heavy problem. Tesla does not disclose the details of its pricing for these services, nor the effective take rate among customers who buy their hardware. It is reasonable to assume that sales of PowerHub and the maintenance contracts are sold, with the vast majority of Megapack hardware sales. But services like microgrid controller would only be available within certain use cases, and we don't have great visibility into either the price or take rate for this service. Nevertheless, we can make some reasonable estimates by looking at the offerings of their competitors. Fluence, a provider of grid-scale storage solutions, provides a breakdown of their revenues and contracted assets. In fiscal year 2022, they reported contracted assets of 2 gigawatts and reported revenue of $16 million. This gives an indicated services price of $8.2 million per gigawatt. There's some rounding in there of assets. Using this figure as a baseline, we can estimate that Tesla's energy revenue for 2023 is approximately 500. Sorry, I'm going a little too fast. Using this figure as a baseline, we can estimate that Tesla's energy services revenue for 2023 is approximately $500 million, or roughly 5% of the energy hardware sales. This seems like an appropriate ratio, though it will undoubtedly increase over time as the cumulative deployed fleet of assets using contracted services with Tesla grows faster than the annual hardware sales. Valuation and sensitivity analysis. In determining the value of Tesla stock, we think it is most prudent to develop a separate build-up for the energy and automotive business segments. As CFO Zach Kirkhorn said on the Q4 2022 earnings call, Tesla's focus is on operating margins. For valuation purposes, therefore, our projections will focus on EBITDA margins and enterprise value to EBITDA multiples. Note that this approach is neutral to a company's capital structure, and given that Tesla's net debt is negative, which is total debt minus cash balance, the implied enterprise value is a proxy for market cap. A key assumption in this methodology is that Tesla's cumulative operating cash flow will be used entirely to finance its capital expenditures over the projection period. Therefore, there's no accumulation of either debt or cash during this period. We have also included earnings per share projections and the future price to earnings ratio to provide a check of our calculated share price estimates. What follows is a description of our base case assumptions. Energy. As noted earlier, Megapack deployments are likely to be a significant driver of growth and profitability for Tesla. However, in addition to Megapack, Tesla will continue to grow its Powerwall products. While we believe that Tesla's solar offerings, especially Solar Roof, will continue to ramp over the course of this period, the impact is likely to be a rounding error compared to the stationary storage assumptions. Therefore, we have chosen to omit solar from the analysis and focus the energy valuation around the ramp of the company's stationary storage revenue and margin potential. At Tesla's Battery Day event, the company laid out a plan to reach 3 terawatt-hours of battery capacity by 2030, with at least 1 terawatt-hour being devoted to stationary storage applications. We believe it's unlikely that Tesla will quite reach this target, as the mining capacity is a significant bottleneck. For our projection, the amount of stationary storage and cars would need. For our projection, the amount of stationary storage. Let's see. For our projection, the amount of capacity that stationary storage and automotive applications would need is roughly 1.5 terawatt-hours by 2030. That's still a lot of lithium. As we gain more confidence around the lithium mining, we may raise estimates provided Tesla continues to show strong execution. As can be seen in the graph, we assume that Tesla will deploy 90 gigawatt-hours in 2025 and 669 gigawatt-hours in 2030. We further assume that the pricing on a $1 per kilowatt-hour basis will decline by 39% over this timeline, and as noted previously, EBITDA margins are projected to peak at 40% in 2025 before normalizing at 30% in 2030. When adding in services margin as described previously, we calculate total energy EBITDA of $15.8 billion in 2025 and $61.2 billion in 2030. We use these figures in determining a valuation as described in the end of this report.
And let me pause here, Matt. So a couple things, one about the 1.5 terawatt hours and another about the EBITDA margins. If sodium ion became mass produced, and CATL is trying to do that now, and Tesla is working on that rigorously as far as researching it, that would allow for a lot of the energy storage to use sodium ion, and then lithium could be used in the EVs or in the highest end electric vehicles such as semi, Cybertruck, kind of how they are using nickel for the highest end of EVs today. So if sodium ion became a big thing, that would definitely help lift part of the limit. But we're also just a little nervous about Tesla's ability to execute on such a massive scale. Certainly Tesla has executed really well to date. Anything you want to add to that comment, Matt?
No, I mean, I think you hit that really well. I think we'll learn a lot more at the Investor Day at March 1st. At least I hope we will, because this is clearly something Tesla is aware of, these constraints. They've gotten into lithium processing with this new facility that they're opening in Texas. But kind of the opening part of that funnel, so the mining capacity, is a bit of a concern. They've mentioned things like lithium extraction as a way to alleviate that bottleneck, but it's hard to give them full credit, like we said, for reaching 3 terawatt hours when we're not sure exactly what their plans are. There's not like a credible path that we know of for how they're going to reach that scale. So, we tried to take a reasonable haircut to their stated ambitions, while still recognizing that like they're going to ramp aggressively, and they're already doing that. But yeah, there are some technological changes that could really change this.
And then on the EBITDA margins of 40% by 2025, in a way, conceptually, you can think about it as we're giving Megapack credit for potentially up to 50% gross margin, but then the operating expenses such as selling, general, administrative, and R&D take off about 10% from that 50. Would you see that's a fair way to think about it, Matt?
Yeah, I mean, I'd probably lower both of those a little bit. So, I might say margin potential of, or like, 45%, just because I don't want to give Tesla like full credit. But if you look at we talked about this earlier in the report, the gross margin of the overall business compared to the EBITDA margin was only about 2% lower than the gross margin, I believe.
Okay.
So, I think that range will be slightly tighter. But I think on Megapacks in particular, like the amount of operating expenses that you're going to need to support Megapack, I think is going to be smaller than what you need for automotive. I mean, if you think of all the service centers they have and all these employees and the rental space that they need all across the world to support sales and to support maintenance, it's like a very big operating expense line item. Now Tesla is incredibly lean with that anyways, but I think on the energy side, they're not going to need nearly kind of the same dollar value of operating expenses that the automotive side of the business leaves. So it needs. So I think the EBITDA margins will be a bit higher, quite a bit higher actually, relative to gross margin on energy than they will be on automotive. One of the just like example, taking a little tangent here, is on the maintenance contracts that Tesla has. I was kind of looking at the way that they have that, and they say that they're going to do inspections once per year, but that they might do them virtually. So like it's just kind of crazy to think that they can run some software, or I don't know, like if they have some like video walkthrough or something like that. I'm not sure exactly how they would do it, but they've actually given themselves the ability to just do a virtual checkup and satisfy their requirements for doing this Megapack inspection, which is a big deal because like if you're talking about tens of thousands of Megapacks deployed throughout the whole fleet, and you need like to hire a team of experts to go and like visit each one of those, that could get pretty expensive. So Tesla is doing some things that I think are going to result in not only high gross margins, but like very limited fixed costs in order to service that base of assets. So it's pretty exciting, I think.
And I'll just point out that the last paragraph that Matt read on this page says that we expect an EBITDA of 16 billion in 2025 from Tesla Energy. So I think Wall Street is at an earnings or a net profit of about 2 billion or less than 2 billion for 2025. So we're meaningfully above where Wall Street is. Just to give people some perspective there. And when we're thinking about the 90 gigawatt hours in 2025, that's Tesla growing from or scaling from 40 gigawatt hours per year to 120. We think they'll be in the process of doing that in 2025. But Tesla has to wait, 3 months or so to recognize profits from things. So we're talking about recognized deployments, and we'll mention that again on the following pages here. Let me share my screen again here, and we'll keep going.
Yeah. And while you do that, it is just a good point to recognize, the deployments that Tesla talks about in their investor decks does not translate directly to revenue. So like if you take the $400 per kilowatt hour, whatever pricing you think they're going to have multiplied by their deployments that they disclose, that's not how you calculate revenue. There's a whole difference of revenue recognition. So as you said, Bradford, the deployments that we are projecting here are really kind of a proxy for the revenue recognized on all battery systems. So that's the way that we're looking at it.
Okay.
So valuation and sensitivity analysis continued. So now onto the automotive side. Tesla's stated goal is 50% annual volume growth, leading to 20 million units sold by 2030. As with our energy assumptions, we think it's prudent to take a significant haircut to this target when developing a base case for valuation purposes. New models, including the Cybertruck and a yet unannounced model, which is believed to be at a much lower price point, will significantly broaden Tesla's TAM, thereby giving the company access to continued strong growth throughout the decade. For valuation purposes, we assume Tesla would reach 4 million vehicles by 2025 and 12 million by 2030. We believe that Tesla's manufacturing margins will decline modestly from the 2022 levels, a product of the recently implemented price cuts and continued ASP decreases over time, offset partially by continued manufacturing process improvements. We assume EBITDA margins on the automotive hardware side of the business will decline to 20% in 2025 and 18% in 2030. However, it also seems probable to us that full self-driving sales would become an increasingly material component of Tesla's overall financial results. The rate of improvement in the software is likely to accelerate, creating a significant value proposition to drivers, even as an ADAS or advanced driver assistance system rather than a full autonomy application. In addition to a higher take rate, we believe pricing will increase and the percentage of revenue which is deferred will likely be de minimis by 2025. Assuming price increases of $5,000 in 2025 and another $5,000 by 2030, and take rate increases to 20% in 2025 and 30% in 2030, we estimate full self-driving revenues of $16 billion in 2025 and $90 billion in 2030. The costs associated with supporting these revenues are minimal, so we assume that 95% of the revenues will flow to EBITDA. Advanced manufacturing. Oh, there's a quote in here too.
I'll go ahead and read that. It's Zach Kirkhorn comments on Tesla Q4 2022 earnings call. He says, so the value of the credits this year will not be gigantic in 2023, but I think it could be gigantic, and we think it probably will be very significant in the future.
So moving on to the advanced manufacturing credits, which Zach was referring to there. While it may seem strange to model out tax credits as a significant driver of value, the sheer magnitude of this benefit, when calculated against Tesla's plans for storage, warrant a separate calculation. The benefits available to Tesla include multiple direct credits, including for manufacturing inverters and various solar components. However, for purposes of our valuation, we are only contemplating the combined $45 per kilowatt hour credit for domestically manufactured cells and modules. This credit is eligible for direct pay, meaning it is not subject to caps or limitations based on a corporate taxpayer's earnings profile. CFO Zach Kirkhorn indicated that for 2023, Tesla anticipates earning $150 to $250 million per quarter, with that amount increasing over time. As can be seen from the quote that Bradford just read, Tesla expects that this relatively small figure will drastically increase in the future as the company expands its U.S. cell manufacturing footprint. This credit is applicable to cells used in both stationary storage and automotive applications. To estimate the value of these credits, we developed projections based on Tesla's combined battery needs, with adjustments to account for indirect cell purchases and offshore Tesla production. Our projections indicate that Tesla will need roughly 1.5 terawatt hours of batteries by 2030 between all its business lines, and we assume that 47% of this need will be fulfilled by in-house U.S. manufacturing facilities, which qualify for the credit. The credit begins to be phased down in 2030 and is phased out entirely in 2032. Since this is not a cash flow with an indefinite life, a discounted cash flow approach is more prudent than applying valuation multiples in a given year. Discounting these cash flows, we calculate a present value of the credits of $35 billion, or $10 of value per share. While the total present value is relatively small, it is possible that these benefits could be extended, as was the case for the production tax credit and investment tax credit for solar and wind, which was initially planned to be phased down by now, but was recently renewed. It is also worth noting that this benefit explicitly because the credits directly offset the CAMT, or corporate alternative minimum tax, meaning that Tesla can have an effective U.S. federal tax rate as low as 3.75% as a result of these benefits. Furthermore, we ignored other credits such as inverters and solar components from which Tesla will benefit directly.
And I should also mention there's credits as far as lithium refining and battery recycling. So that could be 10% of the cost of those. And we're not sure how material that would be, and eventually may model things like that into our financial model.
Yeah, and you know, another point that's probably worth calling out here is there is a little bit of question on whether these credits will go into the gross margin line, or the will show up kind of behind the line as like an add-on. We've assumed for purposes of this valuation model, essentially, that the gross margin, the credits essentially hit the gross margin line, but then there is like a full 15% tax that's being applied against that. So you know, there's room for the margins to be better than what we've modeled here, but it's, you know, it is a little bit up in the air of exactly how these will flow through the income statement.
So we're at the grand finale.
All right, let's talk valuation, my favorite. The projections described above result in EBITDA of $59.3 billion in 2025 and $205.2 billion in 2030. Earnings per share is $11.49 in 2025 and $30.70 in 2030. As can be seen in this table to the right, this results in a base case valuation ranging from $287 to $354. This is not a one-year price target. Between $287 and $54 is what we feel the business is worth today, counting automotive, FSD, and energy storage. We do not believe the stock market will suddenly agree with us. This scenario represents our best estimate of the financial results Tesla is likely to achieve, and we believe there is room to miss both higher and lower than these figures. Alternative scenarios. It is important to note that the scenario above leaves out upside optionality from new products, which could drastically alter the share price of Tesla. Tesla's full self-driving software has been developed with the goal of enabling true autonomy, which would drastically alter the economic utility of Tesla's vehicles. Tesla's humanoid robot named Optimus, which is currently in the early stages of development, could also drastically increase the utility offered to its customers. Robotaxis would free up additional time for commuters, while the bot's total addressable market is the entirety of the worldwide labor market. Under the scenario in which Tesla truly solves autonomy, we believe they could price the software at around $50,000, while achieving effectively a 100% take rate on FSD. While this would increase the total ASP of vehicles to levels that might appear unachievable at first glance, these vehicles would have a drastically higher utilization than personal car ownership, which would effectively lower the cost per mile driven to the end customer. Just making these two changes to the base case outlined above for the year 2030 results in a present value for Tesla stock of $1,184. And that excludes the bot.
Yeah, that excludes bot. Yeah, thinking about the bot, it's a little crazy. The numbers get pretty stupid if Tesla can make a useful robot. If they can make one that's as effective as a human, the robot could work 120 hours a week, so effectively do the work of 3 workers. Potentially Tesla can make these robots for $5,000 each and easily lease them out for like 50 grand a year to manufacturers. And at first they would use that internally. That's just my opinion. And Tesla may, you know, have a different way, and they definitely need to approve. So there's a lot of work to get there. But we've seen with Dojo that Tesla can greatly improve a product in a year's time. Dojo in many aspects 4x in combined performance and cost in just a year time. So we'll see what happens with bot. And go ahead, Matt. Do you want to comment on bot?
Yeah, you know, it's kind of funny. We were just saying in the last page of that report that the TAM of the bot is the entire worldwide labor market, but it's actually bigger than that. Because like that's just what humans can do. But to your point, like what if you have 3 bots per human and they're delivering more value than than humans, because they can work 12 hours a day or something like that. So it's just, Elon talked about this at one of the bot events, where he was just saying like it has the potential to just drastically shape GDP. Like, what is an economy anymore? Yeah. When you can have a robot that we don't know what it will cost to make, but let's just assume it costs $15,000 to make or $20,000 per make, but it can just deliver this huge amount of utility by like doing your lawn and like doing whatever odd jobs you need done around the house, and then or in industrial applications can like handle all sorts of manufacturing processes and can just lower the cost of a huge amount of like of everything. So it's really is the potential to move into an economy of abundance and just like a super abundance of product for everybody. So it'd be both deflationary because it would significantly lower the cost of just about everything that it touched, and it would just drastically increase GDP per capita. So it's like you can't even model this because it just gets nutty. But you know, I think thinking of it as a call option is the right approach in my mind, because it's, you know, you don't want to give it credit for achieving these crazy things. And who knows, maybe the right answer is still 15 years from now, it's just is like a really good industrial bot. Maybe that's all it can do. But there's certainly the promise that it can be much more than that.
Yeah. It's just good to keep in mind that this is under Tesla's umbrella. So we'll finish it out here. Matt, you're doing a great job, by the way.
Stumbling a little bit, so apologies for the few times we've been a little tongue-tied. So continuing on the alternative scenarios case, this figure excludes the potential of Tesla to earn recurring revenue as part of the Tesla network. So back to the autonomy figure, the $1,100 per share. That's only with the increased FSD take rate, not with recurring revenues as like a 30% share on per mile driven. Yet, as drastic as the share price increase would be, we believe it could be dwarfed by the potential of Optimus. While Optimus and robotaxis are the most significant potential value drivers, Tesla has teased many other products, including home HVAC systems, new vehicle types, and large-scale virtual power plants, which could provide incremental value not captured in any scenario presented here. On the other hand, there are significant risks associated with Tesla's aggressive ramp, and it's possible they will not scale even to the reduced levels we've assumed in our base case. Assuming that Tesla's stationary storage deployments only reach 300 gigawatt hours by 2030, and that car sales reach only 8 million units with no increase in FSD take rate or price, we calculate a present value for Tesla stock of $159. This figure could potentially be even lower if the margin assumptions are revised downward. Given the difference between our base case and the share price today, and the asymmetric return profile of the upside scenarios, we rate Tesla as our highest conviction investment at the moment.
Awesome. Great work, Matt. Good, very good writing, very good research and insight, bringing your experience in the energy industry to the table. You know, we baked in a little bit of conservatism in some ways, you know, putting some limits on how many terawatt hours of batteries Tesla's going to use in both automotive and storage. We've limited what we've modeled in a portfolio. One thing that's interesting from this page is in 2025, we have FSD EBITDA, which is earnings before interest, depreciation, and what's the A
interest,
word?
taxes, depreciation, and amortization.
Amortization. We have for FSD, we have that as 11.4 billion. And we have energy hardware at 15.2 billion in EBITDA. And then eventually that FSD overtakes the earnings on the energy side. But this will change over time. This is just a projection. What you should do is add in your own math. One of the ways that I got into Tesla was looking at Wall Street reports and adjusting their math to what I felt was going to happen. So I encourage you to take the numbers we have and put your own numbers in, and you know, play around a little bit, dream about it, and encourage your comments, your questions. We'll try to answer those as possible. But our tweet on this does have 150,000 views on Twitter. So, you know, we'll do our best to get back to people. We do have research on air test systems. We'll be updating that soon. They're a supplier to a supplier of Teslas, and a company called Lovesac that makes furniture in a very efficient way. And we're bringing more research to the table that will make most of it public. And just appreciate your attention. I'm surprised, Matt, your voice lasted this whole time. Anything you want to add or to wrap up, or?
No, I mean, I appreciate you, taking the initiative to get going on these reports, Bradford. It's been, great working with you on this, and hopefully this is useful information that you're putting out for free to everybody. So, just thanks for your kind of leadership on this front, and definitely looking forward to everybody's feedback. So appreciate all the kind of thoughtful disagreements we may have, because evaluation is not, a certainty. It's, you got to put a stake in the ground and say what you think is likely to happen. And of course, people are going to disagree, but I think that's what leads to kind of a healthy debate. And the goal is try to get closer to the truth. But I think the future is looking real bright for Tesla.
Yeah, for sure. I should have said this in the beginning. Maybe you listen to this at a 1.5 times speed or 2 times speed.
I think you did say that. Yeah.
All right. Well, take care, everybody. Love the Tesla community, the community of bulls. Love the discussion. And we'll talk with you again soon. Bye for now.